Yep, you read that right. It happened today. That's right. Today, the Bank of Canada announced that it will be increasing its benchmark interest rate by 100 basis points. That is way higher than economists predicted. If you have a mortgage or a line of credit in Canada, you'll definitely want to stay tuned to see what this means for you. Hey, I'm Jarek, Piwowarczyk, a mortgage broker in Ontario, and welcome to my channel where I demystify the mortgage process, talk home buying strategy, and also help build some generational wealth through real estate. If you're new to my channel, please consider subscribing and hit the little bell icon to be notified of future episodes. Also, please do me a favor and hit that like button for the YouTube algorithm so that this video can continue to help others figure out what the heck this rate hike means for them. So here we are. Inflation hits 7.7%, blowing past the previous Bank of Canada forecasts. Economists predict that the next inflation reading, which is due next week, we might actually see inflation heading over 8%. Now, this is making the Bank of Canada very, very nervous. And since they're responsible for monetary policy, they got to figure out a way to bring us out of this. The US Federal Reserve did this last month by hiking up their key interest rate by 75 basis points. So in a reactionary measure and to help curb inflation, the Bank of Canada fell in line. Today, the Bank of Canada made a huge decision by increasing the overnight rate by 100 basis points, or a whopping 1.00%. This brings the overnight rate, which is the interest rate that banks kind of borrow money from one another short term, to a new 2.5%. From the looks of it, many of us will see this as an aggressive raise, especially coming out of the pandemic, where the Bank of Canada slashed the overnight rate to 0.25% and held it there for a long, long time. We all remember the time of 0.99% rates, but it's hard to remember beyond that. If we look at the rates in 2019 before COVID hit, the overnight rate was sitting about at 1.75, which is higher than what it was sitting yesterday, even after two back-to-back 50 basis point rate increases over the past few months. Today's rate increase definitely puts that overnight rate over the previous marker, but really, if you think about it, we're just a bit higher than the pre-pandemic levels with this raise. That's it. I hope that's a little bit comforting. You might hear some lenders and other agents saying, well, don't worry about it. You can afford it. Let me explain what they mean. We may not want to make a higher mortgage payment, like nobody does, right? Especially alongside the higher costs of living these days, but most of us can do it. Most mortgages in Canada get stress tested in the same way, either using the mortgage qualification rate, which currently sits at 5.25%, or the contract rate, which is the rate that the lender offers you, plus 2%, whichever one is higher. So if your contract rate is 4.5%, then 4.5 plus 2 gives us 6.5%. This 6.5% is higher than the 5.25, and therefore your mortgage is going to be stress tested at this higher 6.5%. So this stress test looks at your payment as if the rate you were paying is 6.5%, and thus builds in the forecasted higher rates. If you're approved for a mortgage with this rate and the stress test, then you have proven your ability to weather the storm. So maybe you don't want to make that higher mortgage payment. I know it, I get it, but you could afford it, at least on paper. Now, since I eat, breathe, sweat mortgages, ultimately my focus is on the question, what does this mean for us? As the overnight rate changes, banks typically adjust their prime rate, which lending devices such as mortgages and home equity lines of credit base their interest on. So with this 1.00% increase in the overnight rate, banks are expected to increase their prime rate by that same amount. So from the outgoing 3.7 to the new 4.70% prime rate. This means that the lenders are passing on those costs of doing business onto its clients, unfortunately. As a result, these individuals in the variable rate mortgages or that have balances in their home equity line of credit will most likely see an increase in the cost of borrowing through an increase in the payment. So, what does this mean? Individuals in the variable rate mortgages and those with balances in their line of credit will see about a $55 increase in your payment per month per $100,000 of balance that you have. So putting this in perspective, if you have a $700,000 mortgage, your payment will increase by $385 per month. No small change alongside all the other costs of living. The question I receive the most of anything right now is what is the rate going to be in a couple months, followed by which is better, fixed or variable? These are topics I'm going to cover in my upcoming videos, so definitely subscribe so that you can be alerted to when those episodes drop. So, with this Bank of Canada meeting in the books, the next meeting is scheduled for September the 7th. What do you think is going to happen? You think they're going to increase? You're going to think they're the same? Drop me a comment and let's chat about it in the comment section. Thank you very much for watching. And as always, be great, do good, and build wealth.